Hello, and welcome back to Trust Talk, where we break down smarter mortgage options for borrowers who do not fit the traditional lending box. I'm Jason Nichols, your host and CMO at Truss Financial Group.
And I'm Jeff Miller, CEO of Truss Financial Group, ranked by Scotsman Guide among the top 10 mortgage brokers by volume. From HELOCs and DSCR loans to financing for self-employed borrowers to senior homeowners, we cover everything that matters for our audience.
Let's get into today's topic. Jeff, today we are getting into a comparison that a lot of self-employed borrowers do not even know they need to understand. Bank statement loans versus profit and loss loans, two non-QM products that both exist to solve the same problem, which is helping self-employed borrowers qualify without tax returns. But they work very differently, and the one that is right for you depends entirely on how your business is structured and what your financials actually look like.
And this is a decision that can genuinely make or break a mortgage application, because the wrong choice between these two does not just hurt your chances of qualifying. It can actually produce a lower qualifying income than you deserve, even when the right option would have gotten you approved comfortably.
So understanding the difference is not just academic, it is practical and it is financial.
It is money on the table. And today we are going to put it all on the table clearly.
Let's get into it. Jeff, let's start with the basics. What exactly is a bank statement loan and how does it work?
A bank statement loan uses your actual bank deposits to verify your income instead of tax returns. The lender looks at 12 to 24 months of your bank statements, either business statements or personal statements depending on the program, and calculates your qualifying income based on what is consistently flowing into your accounts every month.
And the key thing is they are looking at gross deposits.
Right. For business bank statements, the lender takes the total deposits over the statement period and applies what is called an expense factor. That expense factor is a percentage that accounts for the business expenses that run through the account. The remaining amount after that deduction is treated as your qualifying income.
So if your business deposits $30,000 a month and the lender applies a 50% expense factor, your qualifying income is $15,000 a month.
Exactly. And different lenders use different expense factors depending on the industry. A service-based business with low overhead might qualify for a lower expense factor, meaning more of the deposits count as income. A business with high material costs might have a higher expense factor applied.
What about a P&L loan? How is that different?
A profit and loss loan, or P&L loan, uses a CPA-prepared profit and loss statement instead of bank statements to verify income. The lender looks at what your business actually netted after expenses over a specific period, typically 12 months, and uses that net figure as your qualifying income.
So instead of applying an estimated expense factor to your gross deposits, the lender is using the actual documented profit your business generated.
Correct. The P&L statement tells the lender exactly what came in, exactly what went out in expenses, and exactly what was left over as profit. That profit figure becomes the qualifying income.
And that statement has to be prepared by a licensed CPA.
In most cases, yes. Lenders want a professionally prepared document, not a spreadsheet the borrower put together themselves. The CPA's signature and license number add credibility to the numbers.
Okay, so now that we understand how each one works, let's get into when each one actually produces the better outcome. Because that is the real question.
It really comes down to one thing. What does your actual business profit look like compared to your gross deposits?
Walk us through that.
Let's start with when the bank statement loan wins. If you run a service-based business with low overhead, a consulting firm, a coaching business, a marketing agency, a law practice, your actual expenses as a percentage of revenue are relatively low. Maybe you spend 20% or 30% of your revenue on business expenses and the rest is profit. In that scenario, your actual profit is high relative to your deposits.
But the bank statement loan applies a blanket expense factor,
which might be 50% regardless of your actual overhead. So even though your real expense ratio is 25%, the lender is deducting 50% from your deposits to calculate qualifying income. In that case, a P&L loan would show your actual profit, which is much higher than what the bank statement loan's expense factor would produce.
So for low overhead businesses, the P&L loan produces a higher qualifying income.
In many cases, significantly higher. And a higher qualifying income means you can qualify for a larger loan, a better rate, or both.
Now flip it. When does the bank statement loan win?
When your business has high expenses relative to revenue. A general contractor, a retail business, a restaurant, a trucking company. These businesses might gross $500,000 a year, but after paying for materials, equipment, labor, fuel, and everything else, the actual net profit might be $80,000 or $100,000.
And the P&L loan would show that $80,000 or $100,000 net profit as the qualifying income.
which might not be enough to qualify for the loan they need. But the bank statement loan looks at the gross deposits, applies the expense factor, and might produce a qualifying income of $150,000 or $180,000 even after the deduction. Because the deduction is based on an industry standard percentage, not the actual expenses of that specific business.
So for high revenue, high expense businesses, the bank statement loan can actually produce a better number.
Sometimes dramatically better. And that is why you cannot just assume one product is better than the other without actually running the numbers on both.
So the answer to which one is better is genuinely it depends.
It always depends. And anyone who tells you one is universally better than the other without looking at your specific financials does not know what they are talking about.
So for a self-employed borrower listening right now, how do they actually figure out which of these two products is going to work better for their situation?
The starting point is to pull your last 12 months of business bank statements and add up the total deposits. That is your gross revenue for the period. Divide by 12 to get your average monthly gross deposits.
And then what?
Then look at your actual business expenses. What did it actually cost you to generate that revenue? Subtract those expenses from your gross deposits and you have a rough net profit figure. Now compare that net profit figure to what you would get if you applied a typical bank statement expense factor to your gross deposits. Most lenders use somewhere between 40% and 60% as their expense factor depending on your industry.
So if the net profit from the P&L approach is higher than what the bank statement expense factor produces, lean toward the P&L loan.
And if the bank statement approach produces a higher qualifying income despite the expense factor, because your actual expenses are higher than the factor, lean toward the bank statement loan. The goal is always to maximize the qualifying income figure because that determines what you can borrow.
And is it possible to apply for both and see which one produces a better result?
A good lender will actually run both calculations for you before you commit to either one. That is exactly what we do at Truss. We look at the borrower's financials, we run the bank statement calculation, we look at whether a CPA-prepared P&L would produce a better number, and we tell them honestly which path is going to give them the strongest application.
So the borrower does not have to figure this out alone.
They should not have to. That is what a knowledgeable loan officer is for. The product selection should happen before the application is submitted, not after it gets denied.
That is exactly the kind of guidance people need before they start the process. Let's wrap this up. For a self-employed borrower who is trying to figure out which of these two products is right for them, what is the first step?
Gather your last 12 months of business bank statements, and if you have a CPA, ask them to pull together a 12-month profit and loss statement. Bring both of those to your loan officer and ask them to run the qualifying income calculation both ways. The difference between the two numbers might surprise you, and whichever number is higher is the path you take.
And if they want to work with a loan officer who actually understands both products and will run those numbers honestly,
Truss Financial Group. We specialize in self-employed borrowers, and we work with both bank statement and P&L programs. Tell us how your business is structured, and we will tell you exactly which path produces the strongest application. No hard credit pull and no pressure.
that is the move. Thanks for tuning in to the Truss Financial Podcast. If this helped you understand your options as a self-employed borrower, subscribe so you never miss an episode. We will see you on the next one.